Buying a home is usually the single largest purchase most people make during their entire lifetimes. Combine that with the high emotions that are encountered during the process, it's easy to get carried away. By following some simple steps when purchasing a home, you can save significant amounts of money and ensure that you make a smart real estate investment with limited stress. In this video, let's go over 6 things you must do before making your home purchase. Number 1. Figure out how much you can afford. A great way to determine if you can afford a mortgage payment is to estimate the amount you anticipate it being, and then save that amount as if you were actually making the payment. If you pay, let's say, $1,000 per month in rent, and you anticipate a mortgage payment to be $1,300, save the extra $300 per month for a few months to see how affordable it actually is. This will give you a real notion of the actual affordability of your home purchase and help you determine your comfort level of debt. Also, go online and find a mortgage calculator that will give you an accurate estimate of your payment. However, don't forget to set aside at least a couple $100s per month for maintenance, because any homeowner will tell you, you will encounter issues. Welcome to Rich Mentality, and if you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. Number 2, budget for closing costs. Typically, homebuyers will pay between 2 to 5% of the purchase price of their home in closing fees. So if your home costs $150,000, you might pay between $3,000 and $7,500 in closing costs, on average. Buyers pay roughly $3,700 in closing fees. Buyers are often surprised at the amount of closing costs, and some try to roll them into the mortgage if the lender makes this option available. You've probably guessed that this is a very expensive way to pay the closing costs, considering you're amortized over the life of the mortgage of 15 to 30 years. It's much less expensive to save up and pay the closing costs in cash. Number 3, save up the down payment. The appeal of buying with little or no money down is obvious. You don't need a large sum of money, and you can use your savings for furnishing and home repairs, and you can probably buy sooner than later. But there are several drawbacks to borrowing the entire amount or most of the purchase amount. Those extra costs are rolled into your mortgage amount, making you pay a lot extra in the long run. It's best to avoid using a loan that requires a minuscule down payment. The larger your loan, the higher your payments will be, and you'll be stuck with that payment for the life of your loan. To see how the numbers work, calculate the payments of any loan you're considering with a loan amortization. When you're stuck with a large payment, you have fewer options in the future. Any injuries, job changes, or other surprises may be harder to accommodate. Borrowing more of a home's value will increase the overall cost of your home. You might not need to write a check today, but you'll pay much more interest on your loan than you would have paid with a healthy down payment. That difference in interest can amount to tens of thousands of dollars over the life of your loan. To see some of those numbers, look at loan amortization charts for any loans you're considering. When you borrow more than 80% of your home's value, you'll need to pay PMI, or private mortgage insurance, which protects your lender and usually costs you about 1% of the entire loan amount each year. The only benefit you get out of that payment is the opportunity to buy with little money down. That expense can add thousands to your total lifetime cost, and it will further increase your monthly payment. Number 4, boost your credit score. Making sure your credit is as high as possible will be beneficial when getting a mortgage. The credit score is the number your bank will go by to determine if you're a safe borrower. Always pay your bills on time. In fact, most lenders won't even consider lending unless your credit score is at least 620. If your credit score is below this, consider improving your score before applying for a mortgage. In general, the higher your credit score, the lower your interest rate will be, which will significantly reduce your mortgage payment. A small difference in the interest rate on your loan will make a significant difference, especially during the first several years when your mortgage payment is mostly interest and very little principal. For example, an interest rate 1% higher on a $300,000 mortgage will cost you nearly $200 more per month. You want to qualify for the best loan program with the lowest interest rate to keep your housing payment low. Number 5, get pre-approved. Getting pre-approved by your bank will benefit you in more than one way. Firstly, your bank will pre-approve you for a mortgage taking into account factors such as your income, credit score, amount available for the down payment, and other factors. Depending on your personal situation, the pre-approval from your bank will tell you the maximum they're willing to lend you based on your repayment ability, so you'll have a general idea of your price range. Secondly, when you're ready to make an offer on a property, the seller will likely want to see your pre-approval letter, showing that you're capable of purchasing the property. A strong pre-approval letter with your offer will show you're a serious buyer with the ability to close the deal. Number 6, get to know the neighborhood. When you're buying a home, you're not just buying the property, but a piece of the neighborhood too. You need to be sure the neighborhood is a good fit for you with the amenities that you're looking for. To improve the likelihood of your property increasing in value, stay away from areas that are dirty, poorly maintained, and make sure the neighbors are keeping up with their properties. Take a look at the crime rates and try talking with someone who actually lives in the neighborhood to see what they have to say. Walking instead of driving is a great way to get a feel of the area. Also, touring at night as well as in the daytime can be beneficial. In up-and-coming neighborhoods where new restaurants and stores are opening up, will likely experience continued growth. The type of businesses opening up will also give you an insight to the market trend. For example, new daycares and family restaurants will likely show that it's a popular location for young families. Keep in mind that you're much better off buying a less desirable home in a quality neighborhood than a remodeled home in a bad area. There will likely be many real estate opportunities coming as this recession looms. Being more comfortable with these tips and the rich mentality will set you up for a great real estate purchase. With each video you watch here on this channel, building wealth will become your new comfort zone, so stay tuned.